Have you ever wondered what terms like intangible assets or fictitious assets mean in the world of accounting? Well, you're not alone. These terms, among others, form the backbone of financial accounting, a field that can seem complex and daunting. But fear not, we're here to break down these terms to guide you through their meanings and implications. Why? Because understanding these concepts is crucial, not just for accountants, but for anyone who wants to navigate the financial world effectively. So stay tuned as we delve into these intriguing concepts and demystify them for you. First off, let's tackle the question, what are intangible assets? Intangible assets are unique in that they don't have a physical presence, but don't let that fool you. They are still incredibly valuable. Think of things like patents, copyrights, and goodwill. These aren't something you can touch, but they certainly add value to a company. Now, it's not enough for an asset to be intangible for it to be recognized as such. There are a couple of key criteria that must be met. First, future economic benefits must flow from the asset. This means that the asset must contribute to the company's bottom line in some way, either by increasing revenue or reducing costs. Secondly, the cost of the asset must be reliably measured. Only when these two conditions are met can an asset be classified as intangible. So, intangible assets are those without a physical existence, but with future economic benefits. Next up, we'll discuss fictitious assets and preliminary expenses. Fictitious assets are an interesting concept in accounting. Contrary to what their name might suggest, they are not assets at all. They are, in fact, debit balances that appear on the asset side of the balance sheet. These are expenditures and losses that will be written off over future years. Examples of these include the debit balance of a profit and loss account, pre-incorporation expenses, and you guessed it, preliminary expenses. Preliminary expenses are the costs incurred before the incorporation of a business. These are necessary expenses to bring the business into existence. Just like fictitious assets, these expenses have to be written off, but they have a specific timeline. They must be written off over a period of not more than 5 years. In essence, fictitious assets are not assets indeed, but debit balances shown in the asset side of the balance sheet. Let's now move on to contingent assets and subsidiary books. Contingent assets, my friends, are potential assets. The key word here is potential. They may or may not come into existence depending on the occurrence or non-occurrence of a certain future event. An example could be a pending court case that might result in a financial gain. They are not recognized in financial statements but are shown in the notes. Now, let's take a quick look at subsidiary books. These are the books where the first recording takes place from vouchers. Ledger postings are then made from these subsidiary books. They include the purchase book, sales book, purchase returns, sales return, cash book, and journal. These books are critical to accounting as they form the basis for all ledger entries, keeping your financial records organized and up to date. Remember, contingent assets and liabilities are potential assets and liabilities with uncertain timing and amount. Finally, we'll explore the concept of subledgers. Picture this, you're dealing with a multitude of accounts, each with its own unique details and transactions. The sheer volume of information can be overwhelming. This is where subledgers come into play. They're essentially a group of similar accounts that function as an itemization of postings to the general ledger. Think of subledgers as the meticulous organizers in the world of accounting. They gather all the related transactions and neatly categorize them under specific accounts. This makes the task of tracking and analyzing financial information considerably less daunting. Let's dive a little deeper. The general ledger account that summarizes a subledger's account balances is known as the control account. This control account gives you a bird's-eye view of the overall financial situation, while the subledgers provide a detailed breakdown of the individual transactions. For instance, consider accounts payable, accounts receivable, assets, and inventory. Each of these can be a subledger, meticulously recording all related transactions. When you look at the control account, you'll see the total balance for accounts payable. But when you open up the accounts payable subledger, you'll find a comprehensive list of all individual transactions that contributed to that total. So, subledgers not only facilitate the recording of complete financial information related to each transaction, but they also provide an organized, detailed view of the financial landscape of a business. To sum up, subledgers are a group of similar accounts that work as an itemization of postings to the general ledger,